So learning objective 3 introduces you to basically the rules and standards in financial accounting. These are within the United States. This is called GAAP. So when you hear GAAP, don't think about shopping at the mall. Although the Gap store's popularity, I think, is different now. But you're looking at generally accepted accounting principles. This has been going on for a long time. Actually, the accounting profession is overwhelmingly self-policed. It's CPAs that are specialists in financial reporting, and it's CPAs that are mostly involved in setting up the rules that we call GAAP. Okay, and so that's one of the benefits. It is a highly self-regulating body as a profession. The main group that has most of the impact on what becomes part of these standards that we call GAAP is called the Financial Accounting Standards Board. This is think of a Congress full of accountants. How exciting. But basically, these are CPAs that literally will debate and argue how certain things should be handled in accounting. And once those debates and arguments are flushed out and agreed upon, they'll become part of GAAP. You'll get a FASB bulletin, and they'll explain to you how this should be handled. So if you work for this company and this happens in this industry, this is how you should be handling it for GAAP. And that's because businesses change a lot over time. And so new things happen in accounting. It's not static. And so these things have to be debated and fleshed out to decide how you handle it. Ultimately, how we handle it is going to show up on all of our financial reports. Now, again, the government is involved and has input through the SEC. So it's not like the government doesn't have a say. They do have a seat at the table, and they are involved in debating and flushing out how accounting should be reported, how certain events should be reported in accounting. And they're usually done because the SEC, remember, the Securities Exchange Commission, is that part of the government that oversees public trading of companies, the public markets, stock market, bond market. And so basically speaking, they know that the information of those companies is going to be public. They certainly have an interest in making sure that's accurate. So they are going to have a seat at the table to debate how things should be handled. It's only reasonable that they are there. But it's not like it's a government dictate. Like I said, accounting is, I would say, overwhelmingly more self-regulated than anything else. We don't have to deal with, GAAP is specifically within the United States. If you're in almost any other country, they don't use GAAP. They use something called IFRS, okay, the International Financial Reporting Standards. And so there's some differences between how accounting practices are done in America compared to many, many other countries, over 115 other countries, many other countries. Let's just say the rest of the world. And so we haven't come to an agreement to merge generally accepted accounting principles and the international financial reporting standards together. So all countries that are in market economies that do financial reporting agree on all the rules on how certain events and financial issues should be handled and reported. So there's literally two sets of rules. GAAP, again, within the United States, outside of the United States, IFRS. And just like FASB is the group of accountants that basically sit down and debate and decide what becomes part of GAAP, that's what the International Accounting Standard Boards does for IFRS. They're the main international group of accountants that decide how things should be reported. And again, so everything in Europe, I mean, just most places around the world use IFRS. We still use GAAP, okay. The government created something called the Sarbanes-Oxley Act. And as part of that, that was to help end fraud. And for the first time, executives could go to jail for lying on their financial statements, right? Because they have to sign off on them as accurate. Well, the Public Company Accounting Oversight Board, the PCAOB, monitors things for Sarbanes-Oxley, as the Securities Exchange Commission monitors things for the markets and make sure that government rules are being applied. So that's the general overview. Again, the most important thing is GAAP. You have to know what that is. And GAAP, like I said, is set mostly by the Financial Accounting Standards Boards with input from the SEC. Okay. All right. A couple little types of things that your book mentions that are important. Qualities for information according to FASB. Right. So first of all, there are two fundamental qualities of information. One is the accounting information needs to be relevant. In order to be relevant, the financial information would make a difference in a business decision. And in most business decision cases, there's some financial consideration at stake. And so this basically is what we would consider relevance. Okay. Relevance is also, again, there's a couple of other terms that are used here, such as materiality, meaning that basically something's material when it's relevant, and it would make a huge difference in the decision-making of the company because it's heavy financial. The other top fundamental quality is something called faithful representation. And that means that if you're going to be sitting down and doing accounting, you have to make sure that the accounting is accurate. It's a faithful representation of what actually happened. It's complete. It's neutral. It's free from error. It's accurate. It's not fake, right? And so faithful representation, what we see on the financial statements, we have to believe is true. It's complete. It's free from error. That's faithful representation in the accounting information. There are some enhancing qualities when we're looking at accounting. One of those enhancing qualities means that you can compare accounting information company to company because they use the same accounting principles. In other words, all companies that do financial accounting need to use GAAP. GAAP are those common rules that allow us to compare everything. And so basically that's part of GAAP. All the information that you put in your accounting statements needs to be verifiable, right? So you need to make sure that if someone who is independent came in and looked at the books, that if you had $50,000 of accounts payable, that's verifiable. You can show $50,000 of bills you're going to pay. Okay. The information is certainly clear and concise, and so it's meant to be understandable. It's not meant to be sort of hidden, and so understandability is one of those other what we call an enhancing quality. It's consistent because we use the same accounting principles year to year to year. So we can compare year to year to year because we know we've been using the same rules all that time. We've been very consistent in how we interpret financial events and how we represent things on our financial statements. And it has to show what's happened in the proper time. So remember, when we looked at the income statement, it measures a period of time. Well, the accounting information on an income statement needs to reflect literally what happened during that time. It has to be timely. There's certain assumptions that accountants have when they do financial reporting. One is we use the same monetary unit. In other words, every US company needs to report in US dollars, even if that US company has sales in other countries. Of course, if you're in Japan, the dollar isn't going to get you many places, because most people and businesses in Japan will not accept a US dollar as payment. They're going to want their own currency, Japanese yen, for example. And so you have to convert your dollar to Japanese yen and then use Japanese yen to purchase whatever you're buying if you're in Tokyo for the weekend. Well, when we are reporting US company results, even if they had operations in places like Japan or Brazil or Europe, they're going to have to convert the actual currency amounts to US dollars because we are assuming that what they're reporting is in US dollars if they're a US company. Okay. We are also assuming that we're not mixing entities. We're keeping the books of everyone separate. Okay. And so even though these are all car manufacturers, we're keeping these types of records separate and accounted for each company. One of the most important assumptions you're going to be learning about, and this comes back in chapter 4, the periodicity assumption. We divide businesses into artificial time periods. So remember the income statement, right? It's done by the month, it's done by the quarter, and it's done by the year, right? No longer than a year, we keep records for those time periods. Are those artificial time periods that all companies use? All companies use quarters, as you look here, and all companies use a year. And they'll never report outside of the year because it's only a 12-month period of time that they're measuring, okay? And so that's a huge assumption that's built into our first two financial statements, the income statement and the retained earnings statement. Another assumption is that the business is going to be remaining in business forever, okay? We call it the going concern assumption. So the business will remain in operation for the foreseeable future. Walt Disney is dead or on ice, whatever you prefer. But Walt Disney, the company, is a going concern. Henry Ford's been pushing up daisies for quite some time. Ford Motor Company survives. And so these businesses will remain for the foreseeable future. That's a going concern assumption. Once we actually look at a company's records and you look at the assets of a company, we actually are putting down what they actually cost us when we bought them. So if we bought a building in Manhattan in 1950 for $1 million, that's what's on our balance sheet. Not what it's worth today. That's not on the balance sheet. The balance sheet shows what we literally historically paid for our assets. And that becomes a very important principle as we get into chapter 9. We also have to make sure that we are indicating that our assets and liabilities are valued properly on our balance sheet. Because what happens when an asset decreases in value over time? we have to adjust our balance sheet accordingly. And so you're going to be looking at the concept of fair value as we get into chapters 5 and up. Okay. One of the more interesting principles of GAAP, which is generally accepted accounting principles, there's the P word again. You know, we need to make sure that companies disclose all circumstances that would make a difference. In other words, they're relevant. They're relevant. And so those financial statements need to report things that would definitely make a difference to the financial statements. Okay, everything. Companies basically have to weigh whether the information that they provide will hurt them rather versus benefit. So is it beneficial to, you know, provide certain information perhaps before it happened, or will it cost them? So for example, if a company is being sued and it's a big lawsuit, multi-millions of dollars, well, the cost constraint would say that, look, reporting the information that we are losing a lawsuit would cost us more financially speaking than benefit us, because the lawsuit hasn't been decided yet. We think we're losing, but that doesn't, well, we don't even know how much we would pay even if we lost. So we have to say, look, if we report certain things, they should be relatively accurate. They need to be timely. But in full disclosure, we're still in a lawsuit. We haven't lost it yet. We know they're asking for millions and millions of dollars, but the court has not decided whether we're paying that yet. Okay. No problem, Marcia. Have a good one. We are almost done anyway. Actually, we are done. Woohoo! Look at that. And that basically is sort of the wrap here.